Just a few weeks ago, Nvidia made history, becoming the first company ever to briefly cross a 5 trillion valuation, a massive milestone, but one that didn't last long. And now, despite signing huge multi-billion-dollar AI chip deals, including companies like OpenAI, with Nvidia, with AMD, and many others, has started to get investors very, very worried, because the big question that no one has a clear answer to is how long can this AI spending boom actually continue, and does OpenAI, who are doing a lot of deals, actually have the finances in fact to really follow through, because there are also reports coming out that they may need government support or loan guarantees just to fund this computing power that they're demanding, and that's not exactly confidence boosting. And while we're heading into the end of earnings season, Nvidia's results are still on deck, keeping the entire market on edge. We've seen competitors like AMD already showing how volatile this AI race really is, and that's impacted Nvidia. This company has in fact been down in the recent period, as we will come to show you. And to top it off, we're seeing well-known investor Michael Burry take a huge, massive billion-dollar short position against high-flying AI names, Palantir, as well as Nvidia, and this is really making Wall Street incredibly nervous that we may be staring at the start of an AI bubble. Investor sentiment is also sticking firmly in extreme greed. So today, should you sell now and protect your profits, or is this dip really the last great chance to buy Nvidia before the next leg up? So let's break it all down, and we'll start off by saying that last week wasn't really that strong for the market overall, but in particular we did get to see semiconductors battered, Nvidia down 7%, Broadcom, Qualcomm down around 5%, AMD also down quite significantly, 9%. And in fact, this was the worst week for tech stocks, including semiconductors, since Liberation Day April. We saw around $800 billion in terms of a sell-off. The largest one that was hit was Nvidia, losing around $350 billion in terms of their market cap. And even if we zoom out to look at the last month, it's not really been a great trend overall for the market. Yes, some companies like Google up double-digit 15%, but Nvidia under the spotlight was still continuing that downward trend. Now look, having said that, we've got to respect this company. It is up 40% year to date, up around 26 over the last year, and over the last 10 years, incredible. Probably not many companies that would have had a similar performance. They're up more than 25,000%. We also noticed it isn't that far off their all-time highs of $212. Question is this pullback going to continue? Are we going to see a lot more red, something that we just noted last week? Or in fact, as we alluded to, is this a great chance to buy the dip? Now, Wall Street in that conversation believe the answer is yes, great time. They give this a strong buy rating, something they've done for quite some time for Nvidia, Quant with a hold at 3.48, and even Seeking Alpha with their buy at 3.78 does show it's very weak, because only 3.5 is needed to flip this into a buy rating. And if we start the process by looking at the valuation for Nvidia, well, it's trading at a forward P of 33. You might be interested to note that is actually below their 5-year average at 40. In isolation, if we were to look at this, which we shouldn't do, we would say undervalued. This is just one element of our total analysis. And we can also look at the blue tunnel, which for newer viewers highlights the intrinsic or fair value. Firstly, great to see intrinsic price has been increasing over the last year, but we're seeing the share price of Nvidia below the bottom end of the blue tunnel. That is once again an undervaluation signal. But you might be really interested to see here that over the last 12 months, Nvidia has pretty much traded 95% of the time in an undervalued signal. And if we were to zoom out to the last 5 years, you can see that has been the case for quite a large portion, but there are some times where it does trade in a reasonable signal, and very rarely does it trade at a premium. So maybe this isn't something we should see as a surprise. And zooming out to the last 10 years, again, the conclusion is pretty similar. Nvidia, more often than not, does trade, at least in the last few years, at a bit of a discount overall. And whilst their valuation grading gets an F as they are trading at a 73% premium to the sector, bear in mind the sector medium does in fact cover a lot of companies that are of a poor quality, so we wouldn't say read too much into that information. Against their 5-year, as we just pointed out, they're trading at a discount, but the most useful piece of information here is on a PG, price to earnings growth, they're trading at a very attractive 1.16, which is a 34% discount to the sector, but also trading at a 30% discount to their 5-year average. Typically, we say if this is below 2, that is where significant opportunities lie. So Nvidia is a very interesting one. There is still a lot to cover, but if we look right across the S&P on a PG basis, many companies are in fact red. We're talking over 2, not looking attractive at all. And if we just focus on in fact the Mag 7, well, Nvidia does look the most appealing. Slightly different number here based on probably slightly different data, but we can see the conclusion is the same. On a PG basis, Nvidia still looks very strong, and analysts still believe there is a lot of room for this company to run. We have Goldman Sachs, in fact, just last week increasing their price target to $240. They anticipate to see a double beat for Nvidia, as well as seeing a guidance rise. We have Fitzgerald here raising it to $300. That is still quite some significant growth for this company, more than 50%. And we have Melius here putting this to $275 from an already strong $240. Based on data center growth, that is definitely going to be one of the key metrics that analysts are going to be focusing on. And to make it clear, they're expected to report on the 19th of November after market close, so not long to go before we find out how the earnings of one of the most anticipated ones will in fact perform. This is something that pretty much a lot of the market is waiting for and could see very drastic movements one way or another. But if you do want to get some bullish indications, over the last 4 quarters, they have outperformed EPS 100% target. They're projecting double-digit growth over the next 4 quarters. That is still very strong, even though it may be slightly slower than what we've previously seen. And if they do hit their next full accounting period, EPS 668, forward P will come down to the 28 region. So let's look at their history. In terms of the last 2 years, well, earnings per share, they've actually outperformed every single time. That is 8 out of 8 beats. Revenue, they only missed on 1, 7 out of 8. So this is a very strong indication that if you do like to look at history, then we will see that again, double outperformance. And if we look at the earnings per share, well, they haven't exactly missed, going all the way back to January 2010. If we do the same analysis for their revenue, yes, they have missed, but also fairly strong. Whilst not a clean record like the earnings per share, we can see their most recent miss was in fact January 2019. That was very marginal. Even January 2011, a very marginal miss. So things are looking good going into earnings for the company. And we can also look out to the next few years. They're projecting EPS growth into 2026 at 52%. The trend is estimated to continue, although we can see a bit of a slowdown. That is the general theme, and that is probably expected. A company with these numbers can't continue to grow at very large, strong double digit. But even if you look out onto 2028 numbers, a forward P of 22. Now we have some news from days ago where the CEO said China is going to win the AI race with the US. Not something that was taken too well, with a lot of pressure being put on the US regulations, something that isn't seen in China, a lot more flexibility over there. But straight after making those comments, he did take a bit of a step back and clarified here that America must in fact race ahead. And he points here that he contrasts the China's pro-industry energy subsidies with what he says here as excessive Western regulation. So not everything is rosy at the moment for Nvidia, with also the tension still in place with China and US. And we can see here Jensen Huang saying no active discussions on selling Blackwell chip to China. Obviously, we're expecting a bit more commentary when we do hear from their earnings call. But he notes here that the company is effectively blocked from selling their AI chips into China for now. As we can see, there are restrictions imposed on them, not just by Washington, but also Beijing. And also reiterates the fact where he did say China will win. This is ultimately down to lower energy expenses, as well as more favorable regulations. Now, one thing that's also very important to understand is that Nvidia will have a massive impact on the overall market when they do come to report. Interestingly, maybe some of you do hold the QQQ. If in fact you do, well, Nvidia is the largest single holding within that, around 10%. Second place, we have Microsoft, and in third, we have Apple. So if there is weakness to continue, whether it's due to earnings or in fact we get some macro news that isn't to the benefit of the company, then it is likely we will see an overall market impact. But bear in mind, the company continues to chug along with some very, very impressive numbers. Their latest quarter, we can see around $47 billion. Going all the way back to 2014, they've been able to grow their revenue at a compounded annual growth rate of 41%. And if we just single out the data center revenue element, well, based on their latest quarter total revenue, we can in fact see this is the largest driver of their top line. And going back over the last 5 years, they've been able to grow this at 97% on a yearly rate, which is significantly above what we have noted from AMD. And whilst they have reported, still there is a lot of disparity between the two, although a lot of investors do believe that AMD can take away some of Nvidia's market share. Not something we are seeing, at least in the recent period. And if we analyze the institutions with their 65% ownership, they sold 109 billion worth of shares in the last year. They bought a lot more, 3 times as much, we're talking in the same time frame. Only a little bit more though in Q3, not as much disparity as we have noted in previous quarters. Maybe a signal, maybe not, but at least over the last year, and you can still see in the most recent quarter, institutions have been buying more than they have been selling. And if we take a look at what insiders themselves are doing with their 4% ownership, no buying, they've actually been selling around 1.7 billion worth of shares. We will point out though, as always, insider selling isn't typically a bearish signal. They sell for many reasons, personal and financial, and that is quite obvious. Going back over the last few years, the trend is very consistent. Insiders do continue to sell. Having said that, we will in fact highlight who these insiders are, and quite notably we can see the CEO Jensen Huang selling quite consistently over the last few weeks. We are talking about millions and millions of dollars. Again, not something we would factor in, but always great to show the whole picture. Now, we did say their growth is strong, expected to continue, where they get an A-. Top line revenue was up 72% year on year, projected around 68 over the next 12 months, which is well above the sector in the mid to high single digit, but a little bit of a slowdown from their 5-year average. Earnings per share looking still very strong over the next 3 to 5 years, projected 36%, well above the sector at 15%, also above their own historical, so they're growing EPS faster than what we saw on the average at 30%. And then we talk about the profitability, which is an A+, gross margin 70%, well above the sector at 50%, an improvement to their 5-year average of 66%. As always, high quality companies, not just revenue increases will be noted, but also an improvement efficiencies to their margin. Bottom line, same story, 52%. That is very, very strong to see, telling us for every $10 they generate, more than half of that, more than $5, goes straight to the bottom line, well above the sector at 5%. Also, huge improvement to their 5-year average at 37%. And great to see cash from operations, 77 million, not only very, very high, but well above what they were generating over the last 5 years. And it's always great to see their performance against others in the sector. We're talking similar size, Broadcom, TSM, AMD, to see whether some issues or some benefits we're seeing is sector-wide or isolated to Nvidia. Now, they are actually one of the worst performing, we can say that, even though they're up 26% against others in the last 12 months. Broadcom up 92%, TSM up 44%, AMD up 56%. In fact, they're only second worst to Qualcomm, which is up 1% in the period. And if we were to zoom out over the last 5 years, the story does in fact change. They're up more than 1,200%, making them the best performer in this time frame. Again, much better than even the likes of TSM, Broadcom, AMD, and Micron. And over the last 10 years, if we zoom out, they're up 25,881%. Again, the best performer, but do remember, past performance is not an indicator of the future. Then if we do a sim analysis against the S&P and QQQ, because ultimately if you're picking individual stocks, you want them to outperform. Otherwise, you want a stress-free life. You'll just look at something like VO that tracks the S&P or the QQQ. And even with them being one of the worst performers in the semi space in the last year, they've outperformed both the S&P and the QQQ over the last year. That's something also noted by a massive margin over the last 5 years, and that conclusion also holds true over the last 10. There is absolutely no comparison whatsoever. And we can have a quick look at the underlying fundamental metrics. Free cash flow, as always, is something we focus on as opposed to the earnings, which is susceptible to manipulation by management through accounting, but you can see the information on screen nonetheless. Free cash flow per share, massive growth at least over the last few years. It is still expected to continue quite drastically as well over the next 12 months. We're talking going from 2025's $2.48, more than a double, to just over $5. Sales growth, we will cover it, but you can see very strong, although a little bit inconsistent, perhaps to be expected in the semiconductor space, which is fairly cyclical. And shares outstanding, it wasn't that long ago they did announce a share buyback program, which as always means a company returns excess cash to investor pockets. Not something we've seen that much over the last quarter or over the last few years, but maybe one when we look back in another year or two, we will see quite a large reduction. ROIC, one of our favorite metrics, 10% or more, 12 for the semiconductor space. Give us faith, management are able to effectively allocate their capital, and we see very high in 2025, 71%, even with a drop on a trailing 12 month, 68%, still looking very, very impressive. One of the best we've seen, not just in the semiconductor space, but in the market overall. Remember earlier we were talking about improvements to their margins? Well, that is what we note on the operating side, above 16%. Not only do we see that 10 years ago, now sitting at 62 for the full year. Same to go for the free cash flow margin, well above 5%, sitting at 47 in 2025, 44 on a trailing 12-month basis. Then we move to the net debt to EBITDA, which as always highlights the number of years it would take the company to pay off all of their debt net of cash on hand. Below 1.5 is what we want to see, and these in fact correlate to the balance sheet strength. What we're looking at here is 0 across the board, 0 over the next 12 months, telling us it won't even take Nvidia one day to pay off all of its debt net of cash on hand. Very, very strong balance sheet indeed, which we can have a high look at now. But before that, a quick snapshot of their income statement. Yes, revenue has increased phenomenally, as we've highlighted, 5 billion 10 years ago, now sitting at 130 billion. Trailing 12 month, 165, telling us 2026 will be another strong year. But we want to understand, what does the bottom line net income tell us? Is the story very same? Are we seeing the consistency in growth from revenue to net income? And the answer is yes for the large part. 614 million reported 10 years ago, now at 73 billion in the last annual accounts. And we can see again expected based on the trailing 12 month a very, very strong year for 2026. Then we take a look at a quick health check of the company, total cash versus total debt, sitting at 5 billion 10 years ago, now sitting at 57 billion, more than 11 times growth to the cash balance. But as always, one number here, pure isolation, isn't going to give anything away, so we compare it to their total debt numerically and directionally, which has been increasing over the period, around 1 billion, now sitting at 11, but we just saw their cash position is far, far superior, reinforcing what we said earlier. It won't take Nvidia one day to pay off all of their debt net of cash on hand. Before we jump into the valuation, we want to let you know we have released our latest free weekly article. We run through 3 stocks we're buying in November, where we drop one every single Sunday morning to your inbox completely for free, covering severely undervalued stocks as well as what's gone in the markets over the last few days. So click below, you can sign up and read straight away, where you'll be able to grab a copy of severely undervalued stocks for the month of November. Lots of information for each one, the upside that Wall Street themselves see over the next year, and you can also grab a copy of stocks that Wall Street themselves believe have the most upside in the S&P right now. So click below, you can sign up and read straight away. Now jumping into our valuation, we get actually 2 calculations. The first one, intrinsic price, $179. The second one, $164, with just one slight difference between the two, which we are about to highlight. So the first one, 164, which is the lower one, both models in fact based on a DCF. We have the growth rate moving forwards at 20%. You'll see a low, medium, high. As always, these numbers are subjective. You can grab a copy of this model by clicking on the pinned comment below, run into your own numbers, whether it is for Nvidia or any others. And you can also note over the last 5 years it's grown at 153%, over the last 10 years at 104. Now what we've done with this model is we've just extrapolated like we typically do with our previous models, where we use the 2025 rate multiplied by 20%, as in fact you can see here, and then essentially with the growth rate and the discount rate we get the present value of future free cash flow and terminal price, add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and it gets to 164, indicating in fact downside of 13%. Now more important than that, you'll see based on a reverse DCF, what is baked in today if you're buying at $188 is 22% growth moving forwards. You may look at that already and say that is too high, then maybe you see this as potentially overvalued, vice versa, too low, potential undervaluation. We'll also show for transparency if you believe this number is too high at 15%, 117, downside of 38, and in fact these numbers are too low at the higher end of 25%, $230, indicating 22% upside. Now we're not done there, because typically we take the middle rate where we do use a margin of safety, 10%, we execute buy on that if it meets our 3 golden criteria: wide moat, strong financial metrics, good forward-looking data. If that is the case today, then a buy at $148. But what this actually means, if you're adding and you believe this growth rate is acceptable at 20%, then you're paying a 14% premium. If you want a 10% MOS, well, a buy at 148, at 20, a buy at 132, and 25, 123. Wall Street also see into next year $240 price target. That is 28% upside. We'll also highlight for those that want to see at 15% growth, this is saying a 61% premium, but if you believe the upper end to be most appropriate of 25% growth, then actually an 18% margin of safety. So you can see how these numbers here, these growth rates do really affect the overall MOS. But let us know, that is valuation number 1. And if we look at number 2 at $179, the difference here is for the starting point, we've actually extrapolated Q1 and Q2, which probably in our view does make this model a little bit more accurate. And on a reverse basis, a little bit lower. For the first one, we saw 22%, for this one 20.8, and using the middle rate of 20% at 179, still downside of 5%, indicating a 5% premium today. And as you can see, Wall Street's forecast the same, $240, 28% upside. Now again, you may want to look at this on a more conservative basis at 15%. If you do see this as the more reasonable scenario, well, 42% premium. Likewise, if you do want to use the upper rate of 25%, you're actually looking at a very attractive 22% MOS. So it all comes down to the growth rates you believe this company can achieve over the longer term. As we said, you can grab a copy of this model by clicking on the pinned comment below, running through your own numbers for Nvidia or any others, but do let us know, is Nvidia now a buy, hold, or complete avoid? And don't forget as always to sign up to the free weekly newsletter, grab those spreadsheets, come and join us at Patreon where we cover our buys and sells, and as always, have a great day. We'll see you all on the next one.